Today's Quora question: when a stock market crashes and everyone is desperately selling, who is actually willing to buy? Answer by Doug Army, successful entrepreneur, investor and financial consultant. I am. And thrilled to, of course. I've been accused of being a little off-kilter, too. 2009, in the Great Recession, investors fled the stock market like rats off a burning boat. They couldn't sell fast enough. Pundits cried, "It's the end of the financial world. Get out while you can. Buy gold." I fielded phone calls morning to night from scared clients. I did my best to convince them not to bail. Most followed my advice. A couple of them jumped overboard right at the height of the hurricane. If you didn't live through it as an investor, you just can't comprehend how frightening it was and the level of panic that engulfed the markets. In the midst of the carnage, I analyzed underlying values. Stock prices had been decimated. But earnings of most large companies were fine. Their prices had plummeted and their values skyrocketed. The stock market was like Macy's having the white sale of the century. Warren Buffett announced he was buying stocks. He was asked, "Aren't you worried they could go down more?" He replied, "Sure, prices might go down more. But they're cheap now. Eventually they'll go up. And every month I maxed out my 401k and bought stocks, also." Me and Uncle Warren together, of course. He has no idea that I'm his self-adopted nephew. Kind of like buying patio furniture on sale during a winter blizzard. I know spring is coming and it's cheap now. I look back at those investments and they're some of the best I've ever made. They've increased exponentially. And I'm giddy every time Macy's has another white sale. I load up on bargains again. Of course, I've been accused of being a little off-kilter. You build wealth when the stock market is crashing as you understand the difference between price and value. Answer by Kevin McElroy, 10 years working in financial research. Almost nobody. The thing about the stock market, or any large market with lots of liquidity, is that there are always many more market participants not buying and selling than there are active buyers and sellers. Unless you're a day trader, you probably aren't buying or selling the overwhelming majority of the time either. I'm somewhat active, but my peak activity might be 1 or 2 trades in a week. So most of the time, I'm not buying or selling. We know people sell for a bunch of reasons, but people usually only buy if they believe they're getting a good price. A good price is subjective, of course. I don't prefer to buy stocks near all-time highs or at large valuations. Apparently there are plenty of folks perfectly comfortable doing just that, even though to my own subjective reasoning, it's foolish. I would consider it to be much more prudent to wait for a 10% correction. A 40% downturn is even better. I don't know if I would have the patience to wait for a 90% correction, but historically, markets that drop that much from peak to trough are great investments. Another thing to consider is the size of the derivatives market. On any given day, the trading volume associated with stock purchases and sales is not huge, but it's always there. And there are prices that get filled at nearly every penny of bid-ask within a substantial range for most large-cap stocks. People who buy or sell puts and calls may usually choose cash settlement, but not always. I myself frequently sell puts to get put into shares of companies I like at a discount. I might sell an put that's at a 10% discount to the current price. If I get put, then I will let my brokerage put me those shares instead of covering before expiration. So some of those folks who are buying during a crash are people happily picking up shares at the price of their choosing. But the key to remember is how relatively few daily transactions and participants actually affect price. If you aren't an active trader or you don't plan on needing the capital in the short term, it doesn't make much sense to pay attention to daily or even monthly price movements. Unless you're buying or selling today, or you plan to in the near future, I say let the market worry about itself. Another answer is from Anthony, studying mathematics at UC Berkeley. The fundamental misunderstanding is that you are looking at people as being desperate to sell. Stock markets crash because those large weights that held a valuation together do not exist anymore. I've used this chart before to describe something like that before. When the venture money stopped flowing in for the dot-com era, the dot-com stocks began to fall apart. Why? Because those weights didn't exist. That seed money eventually sold off, the 401k and other pension funds reallocated. The founders sold off their stock, and all the bigger players who bought later on into the initial public offering sold off near the top or slightly after the initial descent. But those people weren't desperate to sell their stock. They had already sold in droves before it began. In a TED article, Brian McCulloch describes, between September 1999 and July 2000, insiders at dot-com companies cashed out to the tune of $43 billion, twice the rate they'd sold it during 1997 and 1998. While you think it may be an act of desperation and imagery where everyone is sinking, the main weights are already gone. The people doing the rest of the trading, who hold the rest of the stock, have nobody left to hold that valuation up, and the valuation then begins to sink. It wasn't that the dot-com era was a scam. In fact, the dot-com bubble led to a lot of infrastructure that the internet was missing. However, every now and again, the valuations get far and far ahead of the technological capability of the times. Right now, you could say, we're existing in the second wave of that era. Except, Instead of putting everything on a website, we're putting everything into an application-based format, selling digital advertising space to keep things afloat. It's the same story retold in a different way, but the end result is always the same. The retail trader gets hit the hardest since there will be no one left to purchase at the former valuation anymore. That's when the roller coaster begins to fall hard. If you enjoy this content, please subscribe. We will be back with a new video tomorrow.